Yo, yo, yo. Okay, so listen, the market crash doomers out there, that's exactly who I'm talking about. The people who are telling you that every day the market is going to crash. It's all bullshit. It's to get views. Of course, that gets more views than anything else. I've been doing this for 17 years now, and I've heard everything, and I've watched all of the different videos out there. I've seen the X posts, and they freak you out. They know exactly how to scare you into thinking that the market is going to crash tomorrow, and it stops you from getting started in real estate. And just think about it. Okay, over 17 years, really, not even over 17 years, really a small portion of that is when I made most of my money after I had the skills and all of the experience necessary to be able to really take advantage of that. I had like a 5-year stint where I amassed multiple millions of dollars of net worth. And that's right before I started that. I remember that everybody was talking about how it was just about to come. It was just about to come. What if I would have sat on the sidelines just because everybody was freaking out? And that happens to a lot of people. They sit here and, I'm going to wait till the next crash to start investing, and that's when I'm going to get the really great deals. And then they never do. That's really what happens, because there is always a better time when you listen to everybody out there. Because once again, it tugs on the human nature of all of us, and it freaks us out. And we shouldn't be freaked out. We should just go ahead. So what this video, what this live stream is going to be about is I'm going to explain to you as mathematically as I can, as rationally as I can, why you should stop listening to those losers and you should start taking massive action right now. Because really, it doesn't matter if you're doing it right. That's the premise. Let's get after it. Okay? Here's where I want to start. So really, there's two types of appreciation to think about. There's forced appreciation, and there is market appreciation. Okay, and the reason that people get so freaked out about the market crashing is because they're focused solely on market appreciation. And truly, I did that as well. So like when I look back in hindsight and knowing what I know now, and I look back on some of the early wins I had in real estate, even one of my earliest flips, I did this massive pop top. And I know I've showed you guys pictures of them and stuff, but it was great. It truly was. And I put like $100,000 to $150,000 in my pocket after flipping that house. And, I got done and I thought, oh man, I'm awesome at flipping. I just made 6 figures on my first flip. Well, let's rewind a little bit. I slept on the job site, spent 550 days doing all the work myself. When I look back on it now, knowing what I know, I didn't do shit as a actual real estate investor. What I could have done is simply bought that house and just sat there for 550 days. And I probably would have made a similar amount of money. Okay, because as a real estate investor, you should really be getting paid multiple ways. You should be getting paid as the real estate investor who's taken on the risk. You should be getting paid as the construction company, the OpCo. You should be getting paid as the deal finder, the deal seller, the manager. You should be getting paid by all of these different things. So I simply got paid as being the real estate investor because I lucked out with the market wave behind me. I didn't even get paid to do all that construction. I learned a lot, so I'm not sitting here bitching. Like that was great. But anyway, that is market appreciation, guys. Okay, so this is what it looks like. Okay, you've seen these graphs. Hopefully you know what this means. Okay, here's where the market is, and over time it goes up. Sometimes it goes down for a little bit, then it continues to go back up. That is market appreciation. Okay, and what some people do is they simply buy a house here and they just wait till now it's worth that amount. And that's great. Okay, and generally you have to put 20% down. Okay, so your mortgage is right here. You have 20% equity in the house, and your mortgage is going down over time. The value is going up, and so your equity continues to increase. Beautiful. That's fine. In the long term, Guys, that's always going to be fine. And I just want to show you, because I love this chicken counting tool, and I'm showing you the damn tool. It's free, so nobody's got to worry about it. Okay, it is just like this. It's the wealth calculator, the chicken counter. Let's say I buy a house today for $300,000. It's worth $300,000. I buy it at 80% loan to value, right? Just like I said, I got to put the 20% down. Okay, over the next 30 years, that's how long a general mortgage is. The mortgage is going to go down. You see the mortgage going down. The value is going to go up, and you see my equity is going to go up. So this house that was worth $300,000 today, based on normal market over the last 30 years, it appreciates at 4.27%. Okay, and that is what the wealth would be at maturity. I would have made $1 million. Okay, I think 4.2% is what I have figured in there. An interest rate on that mortgage of 6.5%. Obviously, if the market appreciation was higher or the interest rate was lower, it would all look even better. Okay, that is what you're really doing as an investor, and that always works in the long term. Okay, so it has always worked up till now in the long term. And I'm talking always like thousands of years. Like in ancient Mesopotamia, archaeologists uncovered these like clay tablets that were trading land. So land, which is what you're doing, has, even though there's a house on it that's paying for that land, you're still trading land. And that's been done for literally thousands of years. So what makes anybody believe that's not going to continue to happen? Okay, so it's safe to say that those values are going to continue to rise just like the rest of the economy over time. In the short term, though, that's what all this market crash crap is about, is what if in the short term I get screwed? What if I get pinched? Okay, flippers or even burr investors, same thing, really. You just have a different exit strategy at the end. A flipper sells the house to the market. A burr investor puts a renter in it, gets a refinance done. That's the only difference. The numbers still line up. I'm not going to get into it here, but the short term does matter for you guys. Okay, let's get back to right here. If we're sitting here and you buy this house and all of a sudden the market tanks, okay, right here. Oh, you know what? This is pretty ugly. Let's get rid of this. Okay, what if instead of what we just had, okay, you buy and then the market tanks, and it's going to go back up slowly over time. But what if your plan was to buy here and then you were going to sell up here? Well, now the market's down here, so you selling there means you took a loss. That sucks for sure. You don't want to be in that situation. So you have a couple options. You could hold longer, put a tenant in it, hold it for longer, no problem. Then you get to take advantage of that long-term market appreciation. Or you do what every pro does, and it truly is what flipping is, and that is forced appreciation. Okay. I like to also, if you guys are into like running ads or anything like that, I like to think of this like content. I have organic content, that's my market appreciation, my organic appreciation, or I have forced. That's paying for some Google ads or some Meta ads or whatever. I have forced appreciation. I'm going to force money into your pockets. How about that? Okay. Here we go. Any of you guys out there, questions, hit me. We got the comments pulled up. My brain's not functioning fully right now. I'm on a 5-day fast, and it's supposed to give you mental clarity. It just makes me pretty stupid. Okay, forced appreciation. Here's how that works. Okay, so I'm not doing this crap where I buy right here at market prices and hope that the market continues to go up. No, that'd be silliness, because the market could crash tomorrow, and I want every possible thing in my corner that gives me an advantage. So I buy down here, right? I don't put 20% down and then have this equity because of that. I put 20% down, and now I have this is what my mortgage is, or it's going to be a hard money loan in this case. But look at all that space I have between the actual value. Okay, so now the value, my cash in the deal is going to continue like that. Okay, but here I am, right? So even as we cross this line, even in the worst case scenario, I'm still in the money. Okay, and then just to be clear about what forced appreciation means. Okay, that doesn't mean this $300,000 house that we talked about. Okay, so ultimately we want to get it to $300,000. Now we don't want to count on any, we don't want to count on any of this market appreciation. So I immediately start thinking, okay, here it is. $300,000 is what it's worth today, and I'm not counting on any market appreciation. So when this project's done, I'm still going to think it's $300,000. A pro investor never counts on the market appreciation on a short-term basis. Okay, you invest in real estate because on the long term it always works, but on the short term you never plan on that. In fact, you might even plan on it going down just to be on the more conservative end. Okay, so obviously you're not buying this for $300,000. Even back here when I'm talking about this, I'm not talking about buying it at $300,000 because most of the houses that you buy are going to need some work done. That is the forced appreciation. You buy a house that is undervalued naturally because of something wrong with it, because of some sort of headaches, because of the work that it needs done, or the bad tenant in there that needs kicked out, that needs evicted, because of the headache with the easement or whatever. That house is undervalued. Okay, but it is truly, even at its undervalued, it's still at its market value. Am I saying that to where it makes sense? A house that has just moved a hoarder out and needs $50,000 worth of work, at very best, okay, you should be buying it at $250 today because $250K, because you need the $50,000 worth of project there. Okay, so the $250 would be market value as is. See what I'm saying? After you did the $50,000 of work, now it'd be worth $300,000. But that's not what you should do as an investor. Okay, if it's $300,000 today, there's a few different ways that I should get paid. For one, I should get paid as an investor, which means I should get 15 to 20% of the money that I put in the deal. I should also get paid as the contractor because I'm running these guys. Okay, I might get, let's say, 30% of the construction costs. So if it was $50,000, 30% of that is $15,000. So I want $65K for that construction. I realize that how I started to draw this is really terrible. Oh, Alexis Berber, what's up? I'm adding it to the broadcast. Check it. Mr. Berber or Miss Berber, Alexis, I'm not sure. Thank you for your videos. They've been helping me. Oh, yeah. Hey, no problem. Appreciate that. I thought you had a question, but I do appreciate the nice words. Okay. And if anybody has a question, guys, I'm here for a little bit longer. I'm about to be through this, though. Check this out. Okay, so I should get paid as the contractor. I should get paid as the investor. And truly, if I found the deal, I should get paid as a wholesaler. If I'm selling the deal or managing the real, I should get paid on all those ways. That's what I'm thinking when I'm like going to buy this house. I should get paid for all the little companies that I'm running. All the investor does is finds money, puts money into the deal, and takes a risk. Okay, because there's always a risk associated with investing. And so, yeah, I get paid my 15 to 20% there, but all the work is done by these other hats that I wear, and I better be getting paid for all those hats. Okay, so when I say market value, okay, truly, I guess some people would pay at $250K, and then they would put the $50,000 worth of work into it, and that's how they would get to the $300,000 market value right there. Okay, but we're not doing that crap. Okay, if this house was going to be worth $300,000, I would say I need to get paid. Oh, I'll tell you exactly how I would do this. Easy enough, because I have a calculator to do it. It's all free for you guys. Tools.solohouseflipper.com, or in the free community. If you go to the classroom and go to the downloads, you can get to all this stuff. You can share this in the community so other people can know to use it. It's not Flipperism. That's how you find scopes of work. Here we go. After repair value is $300,000. Let's say the rehab cost was $50,000. Okay, I should be buying this house for $164,320. This is actually the offer I would show the person when I was going to buy it. And it's like this. Okay, 15% rate of return. That means that all the money that I have in the deal, the price that I bought it for, plus the rehab, plus the other costs, that's like closing costs and stuff on the front end. And then we have the, not the cost of the sale, because that happens on the back end. That's like your realtor fees and closing costs on the back end. We're not actually getting a rate of return on that because that money doesn't come out of our pocket. And then also the interest rate and the points on the loan. When I get a hard money loan, I have to pay 4 points up front, and I have to pay interest over the hold time of the property. And so I want to I have all that figured into my rate of return. You know, if I had to pay, let's say 10% over time of hard money, interest and points, well, I want to also get my rate of return on that. You see what I'm saying? Now, some of you guys out there might be actually buying in cash, which is fine. That's one other freaking way I should be getting paid, is as the lender on the deal. I should get my 12% and my 4 points. I'm wearing the hat, guys. I could take that money and I'd go throw it in the stock market if I wanted to. That'd be not the best play, in my opinion. Of course, that's why I have this channel. But the point is, if I'm doing that, I ought to get paid that way as well. So those are all the different ways that I get paid. And that's how I come to my acquisition price of not $250 because of a $50,000 rehab cost, $164. Okay. So I'm like way down here, right? This is not to scale, guys. This is really kind of terrible. But all right, are you getting it now? Let's go through all of this. We have the market appreciation, where basically you're buying it at the $300,000 and you're just waiting for the market to raise like it always raises. That's fine. In the long term, that's always fine. I want that too. That is the cake. Okay, but there's icing on the cake right now. You got to realize that you need forced appreciation to start a house flipping or real estate business today. That is how you make your money today. If you just have a corporate job and you're making $200,000 a year or whatever, fine. Go on Zillow, buy shitty deals, put 20% down, replenish your funds, and go do it again. That's fine. The market's always going to raise. It's the best investment you can have. But if you want to make a business out of it today, you got to have forced appreciation. By the way, this is all going back to the original premise of this video, which is don't listen to all those stupid market gurus out there that say stuff's going to be crashing. We're getting close here. So we have forced appreciation. That means that we're not buying at the $300,000. We're not even buying at the $300,000 minus the rehab costs, which we talked about. We also talked about how we never plan in the short term in your forced appreciation on any sort of market appreciation. Finally, I showed you exactly how I get to this acquisition price of 164. So now I have all of these different things in my favor because I ought to be getting paid those things. Now let's see what that would look like. That means that, okay, this is the market over time, whatever, there's crashes. Here we are at $300,000. Okay. I didn't buy it at $300,000. I bought it all the way at 164 because I wanted to get paid in all those different ways, which I should. So I'm getting paid that on the short term, depending on how you structure your hard money loans. You can get paid as an OPCO today. That's how I get my grocery money. Okay, and then, dang it. Okay, and then over this time, there we go. Let's say it takes 6 months to flip this thing. Okay, I get to the end of here, and I, of course, I have construction in it too, so I'm actually like up here on money in. But I have all of this. So I have the initial because remember, I never plan on market appreciation. So I get my forced appreciation. This is the money I make for being a house flipper, and then this is the money I make for being an investor. And even if the market shit the bed, as bad as it's ever been, what did it crash in 2008? Like 30% or something crazy in certain markets. Even in the worst case scenario, it goes all the way down here. Okay, fine. I lost a little bit of money. Everybody's losing money if the market does that. Who cares? It's like if you are in the woods with your buddies and a bear comes out of the woods. Do you have to be the fastest guy? No, you just can't be the slowest guy. Okay, so in this scenario, you are not the slowest guy. You are in a very good position. Maybe you lost a little bit of money, but the alternative is what? Go continue to work a corporate job. Sorry for you guys that do, but that's where I came from. So I understand you're giving the best hours of the best days or the best years of your life to somebody else. That is the alternative. You don't got to worry about bears at all when you're doing that because, they worry about them. I hope they like you and keep you around because you have no control over that other than being good at your job that's getting somebody else rich. Or you take a risk and you do something like this. Sure, there are bears out there, but you can set yourself up to be in a very good position when those things happen. Guys, I'm getting real close to wrapping up, so if you got any questions, you better hit me right now. That's it. Forced appreciation and market appreciation. Yes, over time, it's market appreciation that you want to think about. But the problem with most of these guys out there, most of the ones that get caught, they are basing their whole investment strategy off of the market appreciation. And I want to emphasize this so much that what people do is they base their plan for buying something on all of these things that they freaking hope work out. Like if that house was $300,000 today, that's the value. They're thinking, okay, well, the market's appreciating at 10% right now. Let's do some math. The market's appreciating at 10% per year right now, which in some years it has. Some years I've seen it do even better. So at the end of the year, it'll be worth $330,000. It's only going to take me 6 months to flip this house. By the time I acquire it, get the construction together, get it to the market and get it sold. So, it'd be worth $315 by then, half the month. So that's how I'm now planning is what they would be doing. What? No, that's called speculation. You're hoping that things continue to go the way they've been going. But they don't do that in the short term. They do in the long term. So you can't plan that way. That's what these speculators do. These are the people that should be freaked the F out about all the market fluctuations. But if you're a smart investor and you buy at the correct value and get paid all the ways that you should get paid as an investor who's taking risk, who's running construction crews, you got nothing to worry about. And even better yet, okay, is if you're getting a phenomenal deal on the front end. Okay, so if you're not even buying, so if I was to say, acquisition price 164 would be great, but maybe I get this one at more like 147, have a 25% rate of return. Now I have more padding in the game for the crap that will inevitably go wrong. It just always goes wrong. Guys, if you watched my last live stream that I did on Friday, I walked into a project that was quote unquote done. It was terrible. Common. I'm not even bothered by it because it happens all the time. And I'm used to it. I'm used to these bad things happening. But I have set my investment up for success from the start by getting not a great deal. It's not even like, a lot of times when you guys hear me talk about getting great deals on the front end, it's not that at all. It's getting an actual reasonable deal because I should be getting paid all those ways. And, the problem is that you can't generally do that if you're not a market of one, meaning like you're talking directly to a seller. If you have any of the middlemen, they know how to get the money and they're going to find the dumb investors out there. That's it. There's like so much dumb money. That's what we talked about when we had like the wholesale company. It's like, oh, hey, let's send it to the out of town investors because they don't, they're not thinking, they're just throwing the cash. They're the money hose. And so be the smart investor and you don't got to worry about all that crap. Those people are talking to, the people who get caught up in those videos, they're probably, I don't want to say anything bad because I've been caught up in them, but it's like in life you have ups and downs. They get me when I'm on my downs, and you can't buy into that stuff. If you do, you're going to miss out on a whole potential lifetime of wealth, growth. Anybody, any questions before I pop off here? Huh? Going once? Going twice? I'm out of here. See you guys. Have a good day.